And now let's start talking about options. Part 2, the basics of options, contract specifications, leverage and risk, basic strategies, hedging and speculation. Lesson number 8, call options. Here, what you will learn here, some introductory notes on options, calls and puts, long and short, what is a call option, basic features of calls, value at maturity versus payoff at maturity. Why options? Options are much more versatile tools than all other existing instruments on the markets. In fact, they make it possible to assume investment positions capable of returning a profit in a range of situations much broader than it is possible with other instruments. Furthermore, it is possible to add components to existing strategies for some time to modify all or part of the expected return and risk profile along the lifetime of the trade. Above all, with options, it is possible to assume directional behaviors as with linear tools, albeit with some cautions of which we will talk, as well as bidirectional behaviors which aim to profit from any direction of the price of the underlying instrument. No other asset allows us to do this. And also non-directional or neutral positions that profit from the laterality of the market. Once again, no other assets allow us to do this. To be stringent, someone could say that there are certificates and other assets that allow you to do the same. Yes, but certificates are just combinations of options. So in the end, it's all a matter of options. It's all due to availability of options. And again, options offer several objective advantages. First, the faculty to break free from the need to make forecasts about future prices. Second, the possibility of not losing even in the face of incorrect analysis, with certain limits, of course. Third, the possibility of managing microscopic analysis errors with the right experience. And four, the chance to adjust existing positions to make them totally risk-free. Options are financial contracts that can be of two types, call or put. Both types can be purchased or short sold, so there are four different basic positions: long call, long put, short call, short put. The implications in terms of risk and opportunity of these four positions are very different, so they must be addressed one by one. Let's start, obviously, from a long call. As defined by any manual, the buyer of a call option, that is a person who makes a long call transaction, pays a price to buy the right to purchase a specific quantity of a certain asset called the underlying asset, which may be financial or physical and is defined by the contract, by one or at a specific future date at a precise price called strike price. Remember the standard definition of a futures? A futures is an agreement between two parties to buy or sell an asset at some date in the future at some time. This is very similar, but there are two main differences. First is that if you remember, when you get to the maturity of a futures, you buy or sell the underlying for the current price. With an option, you purchase with a long call. At maturity, you will purchase the underlying for the strike price, so the price that you decide in the beginning. And the second difference is that with the futures, you have obligations to do something at the maturity. With options, you have the right to do something before or at the maturity. The definition just seen could, at first glance, make the options seem rather complicated tools. And yet, if we want to be stringent, it applies only to a specific context. When the buyer keeps the contract open till the expiration, the underlying asset is physical, and it is possible to deliver or to receive the good. This behavior, in fact, is the answer to a specific need, the need to dispose of the underlying at some future date and at a price set in advance. It is the typical behavior of a company that must protect itself from the risk of an increase in the price of an asset necessary for its own production process, or from the increase of a currency exchange rate on a financial transaction towards another country, or from the possible increase in interest rates on mortgages and variable rate loans, or from any other variable that can be controlled by options written on it. Let's see a couple examples. If, for example, we represent a company that must periodically buy wheat for its production cycle, the current cost of a ton of wheat is $100, just to say. We fear that the price could grow significantly in the near future, and we want to be sure of having the opportunity to buy it at no more than 110, above the current price, but not too much, within the next 3 months. Then we can buy call options written on wheat with a 110 strike and 90-day maturity, paying a price today to have the right to buy wheat at $110 per ton in 3 months, but only if it will be convenient for us. Let's go through this once again. I am a company, I need to buy wheat, the current price is 100. The problem is I do not have to buy wheat only today. I need to buy wheat on a regular basis, let's say every 3 months, every 6 months, every month, whatever. So I do not only have to confront myself with the current price of wheat, but also with the future price of wheat. And what could be the future price? Who knows? So one thing is, let's wait and see what happens. Another thing is, what can I do today to be sure that within some date in the future, I will have the right to buy wheat for a price I decide now. This is what options are for. And here some could say, if it's not 100, but it's up to 110, it's not a big deal. The problem is if it goes over 110. So let's take now the opportunity to purchase wheat for at most 110 within the next 90 days. This, once again, is what long calls are for. Our company has a perfectly clear motivation to do this. It actually needs the goods at a reasonable price, but at some moment in the future. One could say, so why don't you buy now all the wheat you are going to need over the next 6 months, 9 months, 12 months, just to say? The answer is that if I purchase now so much wheat, I have to store it somewhere, and this is a cost. Another example, our company sells a significant amount of final goods to customers located in the United States of America and is paid in US dollars at times other than delivery of the products. If we know that within the next 6 months we will collect $1 million as a down payment for supply, then we also know that we are exposed to the risk of a devaluation of US dollars against euro, or that the euro-dollar exchange rate is appreciated, euro stronger, dollar weaker. This is because when we will be paid in US dollars, we will very likely have to convert the sum received into euros to pay suppliers, employees, loans, and all the rest. If the exchange rate today is 125, just to say, then the $1 million we will receive in 6 months to date is worth 800,000 euros. But if in 6 months, when we will get the money, the exchange rate is 135, just to say, then that same payment of $1 million will be worth only 740,000 euros approximately. So we will lose almost 60,000 euros due to the exchange rate, due to the change in the exchange rate. So we must protect ourselves from this risk. And to do so, we buy a call. For example, strike 125. and we will have the right to change dollars in euros for 125 each, a right we will exercise if the forward exchange rate is greater than the initial exchange rate. But in the vast majority of cases, the nature of the call purchase operation is very different. I want to make money from the possible increase in the share price using a tool that allows me to obtain that result with a very small amount of money and a strong leverage effect. However, operations of this kind are not carried out until expiry, because those who carry them out do not intend to have the underlying delivered and only want to make money on the short-term behavior of their price. Here then is that if we look at the purchase of a call option as a speculative operation, the definition changes radically. A long call is also a way of speculating on the rise of a financial instrument by investing a small amount of money and benefiting from a high leverage. All this because options are fungible instruments like shares. Therefore, once bought, they do not necessarily have to be kept until expiry and can instead be resold at any time, even after a single second. A long call, therefore, can be used to speculate on the possible short-term rise of any kind of underlying asset, buying and reselling the option after a short time and making a profit on the possible positive price difference. But now we have to face some first complications. A first is given by the fact that during its life, the option faithfully replicates the eventual upward movement of the underlying only in some cases, while most of the time accompanies it in a less than proportional way. So, if the underlying appreciates €1, you don't earn €1 from the option, but only a fraction of a euro. The ability of the option to perform exactly as the underlying occurs in fact only in certain precise situations, in particular at maturity when replication is perfect, while generally a partial replication of the movement of the underlying is obtained. Moreover, the replication ratio is not constant. It changes according to how the underlying moves in relation to the strike of the option, and not just it, but here I don't want to make it too complicated, so let's stop here. A second complication is that even if the underlying is appreciated, it is not said that the call option increases in value, because its price depends on many factors, some of which act against the purchased position and can neutralize in part or in all the benefit from the other factors, those favorable. Another complication is that not all call options allow you to do something only on their expiration day, as some of them give you the right to buy the underlying at any time. If, for example, the call on wheat seen in slide 63 offers this opportunity, then the company can exercise its right to buy wheat at $110 per ton on any day between the option purchase date and the option expiry date included. Should at any time before the deadline or even on the same expiry day, the price of a ton of wheat be higher than the strike, say for example $130, then the company could decide to exercise its right to buy wheat at $110 per ton. If on the other hand, the price of wheat at maturity is below the strike, let's say $80 per ton, the company could just let the contract expire without doing anything. It would make no sense, indeed, to exercise the right to buy a ton of grain for 110 each when you can buy them in the market for just 80. The buyer, in fact, has the right to purchase, not the obligation. And to get this right, you risk losing the only price initially paid. As per contractual specifications, in fact, the price of an option can never become negative, so at most you can lose all the money paid. The choice between exercising at or before it depends on the fact that in some cases the exercise is allowed only at the end, in others at any time. And also from the fact that in some cases the settlement of the contract provides for the physical delivery of the underlying, but in others it only involves cash settlements. The right of exercise and the type of regulation at maturity are therefore very important concepts in the world of options, concepts that we will return to shortly. Let's see some contract specifications of options. In this example, we are looking at a call on the FTSE index, strike 20,000 points, expiry December. The type is a call, the underlying is the FTSE index. The strike or exercise price or basis is 20,000 points. The style is European. The price is in points, 468 in this example. The value of the point called multiplier is 2.5 euros. So the premium, the one that is the real total cost of the option, is the price times the multiplier, 1,170 euros. The contract side is a half of the FTSE index. Looking back to the FTSE index futures, if you remember, the value was 5 euros a point. So it was worth an entire FTSE index. An option on the FTSE index is worth a half of that index. Expiry is the third Friday of each expiration month. Settlement at expiry and exercise, the settlement is cash, and there is no chance of exercise since the index cannot be traded nor delivered. In the next slides, we will go into much more details about all the above, of course. Let's see another example about a stock option. In this case, we're looking at a call written on any strike 15 euros, expiry March. The type is still a call. The underlying lot is 500 shares of any. The strike exercise price or basis is 15 euros. The style is American. The price 0.2445 euros per share. The premium total cost of the option is the price per share times the lot, 0.2445 times 500 shares, 122.25 euros. The contract size is the value of the equivalent position in the stock. If I purchased right away 500 shares of any, I would pay 7,500 euros. Expiry, the third Friday of the expiry month. Settlement and exercise, there's a physical settlement, and exercise is possible at any time till the day of expiry. Let's speak of expiry, exercise, and style. If at any time before the expiration of a call option the underlying reaches and exceeds the strike, the holder of that call, the person who purchased it, opening a long position on it, may find it convenient to exercise his right and have the underlying delivered to the predetermined price. This behavior is called early exercise and can only occur on options written on underlying assets that can be physically transferred. In fact, it would make no sense to request the delivery of something that cannot be delivered, such as the FTSE index. The possibility of exercising before the deadline is set by the style of the option, which can be European or American. If the style is European, exercise is possible only on the day of expiry. If the exercise style is American, the exercise is possible any time. Pay attention that the style has nothing to do with the country. You can have European style options listed on the American markets. You can have American options listed on the European markets. As specified above, call options can be used for hedging purposes, and in fact this is their use for which they have been designed, as in principle all derivatives. But they can also be used for speculative purposes to benefit from upward movements of the underlying over a certain time horizon using financial leverage. As we will see then, options, both calls and puts, can also be used to take advantage of situations of market laterality, where any other financial instrument does not produce any income. Now we will deal with what happens to call options when they expire, because what happens before the maturity is much more complex and we will deal with it later. Let's start with the case of a cash-settled call options, because even if in the books you always find the value of an option, the payoff of an option at maturity in the same way with the same charts, you have to make a distinction between cash-settled and physically settled options. Nobody does it. So, value at expiry of a cash-settled call and moneyness. Since the call represents an advantage for its buyer only if the price of the underlying exceeds the strike, then for any spot price at maturity equal to or less than the strike, the value of the option is 0. Here, for any price, on the x-axis we have the spot price, on the y-axis we have the value of the option at maturity. Pay attention, what the option is valued at maturity, how much it is worth. For any price of the underlying at maturity equal or lower than the strike, we lose everything because the option is valued exactly nothing. For any price above the strike, on the other hand, the option has a positive value proportional to the distance between the spot price and the strike. €1 above the strike means a value of €1 for the option. As previously indicated, in fact, at maturity the option perfectly replicates any positive change in the underlying. The graph of the value of a call option, no matter whether it is bought or sold short, is this. Technically speaking, when the spot price is lower than the strike, any time, not just at the maturity, the call is said to be out of the money, OTM. When the spot is equal to the strike, it is called at the money, or if it is very close, it's called near the money. And finally, for any spot price higher than the strike, the call is called in the money, ITM. These labels identify the so-called moneyness of an option. What is the payoff at expiry of a cash-settled long call? The one just seen is the value of the option, but what is the profit or loss on the long call? This one is the profit or loss. The premium paid for the purchase of a call is an outlay that is not returned in any case. Pay attention, if you buy a call and you keep it till the expiry date, you will lose the premium paid no matter what happens, okay? Because the option gives you rights, and for those rights you have at least to pay something. So even if in the end you get an advantage from the option because the price of the underlying reaches and crosses the strike price, you will leave in the plate the premium paid. Also because if you got restituted of the money invested, you would have a double advantage, the advantage of the behavior of the underlying plus the premium restituted. This cannot happen, of course. So the premium paid for the purchase of a call is not returned in any case, except against a sale of the option before maturity. Let's go through this again. If you buy the option and you wait to the maturity, the premium paid will not be returned. If you buy the option today and you sell it within 1 hour, you will have a profit or a loss depending on what happened to the price. So you are not losing anything, okay? So, the premium paid is not returned in any case, except the case where we sell the option before the maturity, which may result in a profit or a loss depending on how the market has moved in the meantime, of course. Given the graph of the value of a long call settled for cash at maturity seen in previous slide, we are now able to draw its payoff at the maturity, read it the risk and return profile according to various spot prices. If the option expires out of the money or at the money, that is, the spot price is lower or equal to the strike, then the option is devoid of any value and all the premium paid is lost. If the spot price is above the strike, you can have two situations. For spot prices slightly above the strike, you still lose, but not the entire premium. You start gaining money, but not enough yet to cover the premium paid. So somewhere there has to be a break-even point. The break-even point is given by strike plus premium. For any spot price higher than strike plus premium, then a net profit occurs. And if you look at the chart, you can say you have a maximum potential loss and unlimited potential profit. And this could lead to think that long call options are perfect. But things are quite complicated, much more complicated than they seem. And we will talk again of this very soon. What about the short seller of the call? The writer of an option, call or put, it doesn't matter, collects the premium paid by the buyer, but assumes a duty to pay the buyer if the spot price is above the strike price. This in case, of course, of the call. If we do not consider only what happens at maturity, if an increase in the value of the call accompanies the growth of the underlying, this change in value is a theoretical profit for the buyer and a theoretical loss for the seller, to which this loss is charged for effect of the mark-to-market mechanism, the same that applies to futures. We will speak of the mark-to-market applied to options in a lesson further. If the option expires out of the money or at the money, the writer retains the entire premium paid by the holder. Then, for any spot price at maturity between the strike and strike plus premium, the writer keeps only a part of the premium paid by the holder. And finally, for any spot price higher than strike plus premium, the writer loses money in proportion to the climb. In theory, there is no limit to the potential loss. And now a very important question. You have a maximum potential profit and unlimited potential risk. Is the writer so stupid? And as I already told you, it's a more complex problem than it seems. We will speak of this in time. Let's speak of holder versus writer at expiry. In general terms, the position of the option buyer is the expression of the expectation of a price movement in a specific direction by a certain future date. A call holder expects a bullish movement, but that movement has an expiration date. There are therefore two hypotheses implicit in the behavior of the buyer: a specific price direction and a sufficient time for this to occur. Think of buying a stock. When we buy shares, the price does not have to go up immediately to give us a profit. If we can wait, it may just be a matter of time before we get it. But this is a luxury that the buyer of a call option cannot afford, because sooner or later there is a deadline to be reckoned with. Time is the worst enemy of options holders. Again, the holder must deal with two key variables, price and time. Time is money, and when events do not move in the favorable direction, talking about options trading, time is a cost. In fact, to answer the question of whether reasoning at maturity it is better to be holder or writer of options, we still lack a fundamental element to consider: the probabilities in favor of each of the two parties, a concept to which we will return later. So, payoff at expiry of a physically settled stock option call. So far we spoke of cash settled. What happens if the settlement is physical? When the settlement involves the physical delivery of the underlying stock at maturity, things change radically. We are talking about stocks. Later on, we will talk of commodities. Assuming that the call holder holds the open position until expiration because he wants to have the opportunity to buy the underlying at a certain price, what happens at maturity is basically this. 1. If the option is at the money or out of the money, there is no exercise because it is not convenient. The option holder does not buy the underlying and loses all the premium paid. If the option is in the money, scenario number 2, the exercise is automatic. The counterparty, anyone who has placed themselves on the short selling side, not necessarily the original counterpart, is asked to deliver the underlying, which is loaded into the portfolio of the holder of the option. The premium paid has in any case been lost, despite the fact that the exercise took place upon expiration. In essence, the value at expiry of a call option settled with physical delivery is always zero, the value of the call. The result, therefore, is that there is no profit on the option. The shareholder transforms his position into a new one on the underlying, after which it all depends on how the letter's price behaves. You add an option, now you have a stock. Then it all depends on what happens with the price of that stock. The first consequence of the exercise is that the holder must pay the entire counter value of the underlying, thus losing the advantage of the leverage. But above all, the premium is gone, and that's the only sure result of the operation, because the only thing that remains in his hand is a theoretical profit on the underlying. The only thing that's certain now is the loss of the total premium paid. What if the underlying is a commodity? In the commodity market, this is very different. First, commodity options are actually written on futures, not on physical goods. Consequently, if you find yourself with an open position on the expiry of a call option on oil, just to take an example, you become the owner of a long oil futures, not a certain amount of physical oil. Then, of course, at some point, the oil futures expires as well. And in that moment, it would be theoretically possible to end up with the physical asset in hand. But in reality, this does not happen because only some specific subjects can have the good covered by the contracts delivered. A trader who holds positions in futures close to maturity is forced to close them on certain days before the expiration. All of this we have already said back in some previous lesson. For now, that's all about call options. Thank you for your attention.